the classic one that we see a lot of traders trade on, investors watch, are earnings dates. Eric So at MIT, Josh Libna at NYU, Ed Hahn at Stanford have all written articles, academic research on when earnings dates move. It's not just the earnings date itself, but when an earnings date moves, it's a signal. Again, it's corporate body language. So when an earnings date is moved back, when it's delayed, that's usually viewed as a negative indicator. If a date is moved forward, it's a positive indicator. And again, the research shows that you can make a good amount of alpha just by following that simple type of strategy. Other examples are, postponing analyst days. Another example is with a company is supposed to speak at an investment conference, and maybe a lower level person is supposed to speak, and the person gets swapped out for a higher level person. That's a positive indicator. If the CEO is supposed to speak and suddenly it gets swapped out for a junior product manager, that's probably less of a good sign. If it gets postponed, like the Ford example, then it's clearly a negative example. So it's not just the events, but it's the revisions, it's how these change. Another one is shareholder meetings. If a shareholder meeting, again, there's research in the literature that shows that if a shareholder meeting is supposed to be run in the company's host city, in their home city, and suddenly they move it, let's say from San Francisco, they move it to New York City, that's considered a very strong negative indicator. And so it's not just the event themselves, although the event themselves are very, very important, but it's the changes to the events that that's what this corporate body language is all about.